You've probably heard people say, the next big crash is coming, turn on the news, and every few years someone is warning that the entire system is about to collapse. And yet, here we are. The world didn't end. The markets fell, sure, but then, almost like magic, they bounced right back. That leaves us with a big question. Are financial crises still opportunities? Or has the game completely changed? Let's rewind. For decades, every major crash was followed by stories of people who bought at the bottom and became rich. Think of the Great Depression in the 1930s. Most businesses went under, but a few, like General Motors, survived, bought up the competition, and became giants. Fast forward to 2008, the financial crisis wrecked banks and real estate. But people like Warren Buffett jumped in, bought assets cheap, and came out wealthier than ever. For a long time, we were taught the same lesson. In every downturn, there's danger, but there's also opportunity. If you were brave enough to buy when everyone else was panicking, you could change your life. You could pick up assets at a discount and ride the wave up. But here's the problem. That rulebook doesn't seem to work anymore. Since 2008, crashes still happen, but they don't look the same, they don't last as long, they don't wipe out the system. And they rarely give regular people enough time to buy at the bottom. In 2020, during the pandemic, the US stock market dropped hard. For a moment, it looked like the old pattern was back. Investors got ready to scoop up deals. But before they could even act, the Federal Reserve printed trillions of dollars, slashed interest rates, and the market roared back in weeks. The chance to buy low? Gone almost overnight, even the legends missed it. Buffett himself didn't make a big move before prices recovered. Neither did other giants on Wall Street. That tells you just how different the game has become. And here's the kicker. If the richest investors can't catch the bottom, what chance does the average person have? If you're waiting for another 2008-style collapse to buy cheap assets, you might be waiting forever. The rules of money have shifted. Governments don't let the system fully reset anymore. Instead, they pump in cash, they press the fast-forward button on crises. And this brings us to the real question. If the old rules of wealth no longer apply, what are the new ones? And more importantly, how do you play this game in a way that actually works for you? Stick around, because in the next part, we're going to dive into the history of past financial crashes. And once you see the pattern, you'll understand why the wealthy are playing by a different set of rules than everyone else. Crashes aren't new. They've been happening for over a century, and for a long time they followed a predictable rhythm. Look back at the Great Depression of 1929. The stock market collapsed, banks failed, millions lost their jobs. But in the middle of that chaos, some companies didn't just survive, they thrived. General Motors was one of them. While many automakers went bankrupt, GM bought their assets for pennies. By the time the economy recovered, GM was the #1 car company in the world. Now fast forward. In the late 1990s, the internet bubble inflated. Startups with no real profits were valued at billions. In 2000, the bubble burst. Companies collapsed. Stock prices crashed. But those who invested in the survivors, Amazon, for example, saw fortunes multiply. What looked like disaster was actually a reset. Just a few years later came 2008. The housing market crashed. Banks failed. People lost homes, jobs, and retirement savings. But investors with cash on the sidelines, like Warren Buffett, stepped in. He bought stakes in companies at bargain prices. When the market recovered, his wealth exploded. This was the old pattern. Every big crash cleared out the weak players. It punished those who were over-leveraged, and it rewarded those who had patience and cash. It was like a brutal but predictable cycle. You knew pain was coming, but you also knew opportunity would follow. Here in North America, you could see this on the ground. Take real estate after 2008. In cities like Phoenix, Las Vegas, and parts of Florida, homes that once sold for $300,000 dropped to $120,000. Investors who bought then. Today, those same properties might be worth $500,000. They turned one of the worst housing crashes into a ticket to long-term wealth. Or look at stocks. Apple traded for about $12 a share in early 2009. If you bought $10,000 worth then, you'd be sitting on well over $100,000 today. Not because you worked harder, not because you were smarter, but because you understood the game buy when others panic. That was the rulebook we were all taught. Wait for the crash. Be greedy when others are fearful. That's how you build wealth. But something happened after 2008. The rulebook started to break. The crashes didn't feel the same anymore. The dips were shorter. The rebounds were faster. The window to buy cheap assets nearly disappeared. And if even Warren Buffett struggled to play the old game, what does that mean for the rest of us? The answer lies in understanding what changed after 2008, because that's when the financial system quietly rewrote the rules. In the next part, we'll break down exactly how the game changed, what the Federal Reserve did, and why it matters for your money today. Something shifted after 2008. The crash came. Banks were failing. People were losing homes. It looked like another Great Depression. But this time, the government didn't sit back. They stepped in fast. They bailed out the banks. They cut interest rates close to zero. And then they did something that shocked the world. They started printing money on a massive scale. Trillions of dollars were injected into the system. The stock market, which had been falling like a stone, suddenly reversed. Within months, it was climbing again. The recession was deep, but the recovery was quicker than anyone expected. For ordinary people, this was confusing. They thought a crash would give them time to buy cheap houses or cheap stocks. But before they could act, prices were already rebounding. It felt like someone had pressed the fast-forward button. This wasn't a one-time event. In 2020, when the pandemic hit, the market crashed again. People panicked. Investors prepared for another long downturn. But the Federal Reserve and the US government flooded the system with even more money. Stimulus checks went out. Businesses got loans. Markets bounced back in weeks. It wasn't just small investors who missed out. Even the biggest names on Wall Street were caught off guard. Warren Buffett, known for buying during crises, couldn't move fast enough. By the time he considered big purchases, the market had already recovered. His company's profits dropped by more than half. The message was clear: the game had changed. In the past, crises created new winners and losers. After 2008, crises became something the government could pause or soften with money printing. The old cycle of collapse and rebirth was interrupted. This is where a new idea stepped into the spotlight: an economic approach called modern monetary theory, or MMT. It suggested that if a government controls its own currency, it can always create more money. That money can be used to stop crises before they spiral out of control. This is why many now believe there may never be another great crash like 1929 or 2008, because governments, especially the US, won't allow it. They will print money instead of letting the system collapse. But here's the catch. If the old rule was wait for the crash and buy cheap, and the new rule is the crash gets papered over with money, then where does that leave you? If you're playing by yesterday's rules, you'll always be one step behind. To understand how to move forward, we need to break down how this system of money printing really works. And that's exactly what we'll explore next. We'll take a simple look at modern monetary theory and why it turned the old playbook upside down. Let's break down what actually changed. For decades, money had rules. One of the biggest rules was the gold standard. Under the gold standard, every US dollar was tied to a fixed amount of gold. If you had $100, the government had to have the gold to back it up. That meant there was a limit. You couldn't just print endless money. You had to dig more gold if you wanted more dollars. But in 1971, the United States made a huge move. They cut the link to gold. From that moment, the dollar was backed by nothing but trust. Trust in the government, trust in the economy, trust that people would still accept dollars as payment. This opened the door to a new way of thinking about money. Economists called it modern monetary theory, or MMT. The idea is simple on the surface. If a country controls its own currency, it can never truly run out of money. Why? Because it can always print more. If the government owes $1 trillion, it can just create $1 trillion new dollars to pay for it. That sounds almost too easy. And in a way it is. But it works at least for countries like the United States, because the dollar is the world's reserve currency. Everyone around the globe needs it for trade, for oil, for savings. So when America prints more dollars, other countries end up absorbing some of the cost. You've seen this in action. In 2020, the US sent out stimulus checks. People bought groceries, paid rent, ordered on Amazon, and even invested in stocks and crypto. That money didn't come from taxes. It came from the government creating new dollars out of thin air. Think about it. In the old days, money printing was treated like a last resort. Now it's treated like a tool, a way to keep the system moving, a way to avoid deep recessions, a way to make sure the game never fully resets. The only real limit is inflation. If printing gets out of control, prices rise too fast. We saw this in 2021 and 2022 when gas, food, and rent all surged. The money supply had ballooned, but wages didn't keep up. So while more dollars were out there, each dollar bought less. For the wealthy, this wasn't a disaster. Their assets, stocks, real estate, businesses went up in value. They owned the things that got more expensive. For the average person, it was different. Savings lost power. Paychecks didn't stretch as far. The very strategy meant to save the system ended up hurting those without assets. This is the core of the new game. Crises aren't eliminated. They're managed by flooding the system with money. The result? The wealthy get richer. The middle class struggles with higher costs. And the old idea of waiting for a big crash to buy cheap is no longer reliable. So here's the real challenge. If the government can always print more money, and if inflation eats away at the value of your savings, then stacking cash under your mattress won't protect you. In the next part, we'll talk about inflation, why your dollars keep shrinking, and how the wealthy are turning that reality into more power and more wealth. Let's talk about inflation. It's a simple idea. When more dollars are printed but the amount of goods doesn't grow as fast, prices rise. That's inflation. Here's an easy way to picture it. Imagine a small town with only one farmer's market. Every week, the farmers bring in 10 baskets of apples. The town has $100 total. Each basket costs $10. Now imagine the farmers get better tools and can bring 20 baskets, but the town still only has $100. People don't suddenly have more money, so the price of each basket drops to $5. That's deflation. Now flip the situation. Keep the same 10 baskets of apples, but the town suddenly has $200. Now everyone has more money to spend, but the apples didn't multiply. What happens? The price of each basket goes up. That's inflation. This is what happens when governments print money faster than the economy produces goods. Your dollar buys less, not all at once, but slowly, quietly. Month after month, look around North America today. Gas prices are higher. Groceries that cost $80 a year ago might now cost $100. Rents in cities like Toronto, Vancouver, New York, and Austin have doubled in just a decade. Meanwhile, wages haven't doubled. Most people feel like they're running on a treadmill that keeps speeding up. This is the hidden tax of inflation. Your paycheck might stay the same, but the cost of living eats away at its value. It's like pouring water into your orange juice. You still have the same glass, but the taste gets weaker every time. Who benefits from this? The wealthy. They own stocks, real estate, and businesses. When money is printed, those assets rise in price. A house bought for $300,000 might sell for $600,000 just 10 years later. The rich aren't holding cash. They're holding things that grow when money loses value. The middle class and the poor don't have that advantage. Most of their wealth is in savings accounts or paychecks. Both lose value in inflation. That's why it feels harder to get ahead. The rules of the game are rewarding those with assets, not those with savings. So ask yourself this. If saving cash isn't enough anymore, how do you make sure you're not falling behind? That's what we'll uncover in the next part. We'll look at how the wealthy are really playing the game and how you can learn from their strategy to build wealth in this new era. The wealthy don't sit on piles of cash. They know cash loses value every year, so they put their money into assets that grow while inflation eats away at everyone else's savings. Think about real estate. In many U.S. cities, home prices doubled or even tripled after the 2008 crash. Who benefited the most? Investors who had cash ready. They bought properties when families were forced to sell. Today, those same homes are rental machines, generating passive income every single month. Look at the stock market. When the pandemic hit in 2020, the S&P 500 dropped over 30% in just weeks. It looked like another long depression was coming. But then the government injected trillions into the economy. Stocks didn't stay down. They shot back up. Billionaires saw their wealth rise faster than ever. Ordinary investors often missed it. They were too afraid, or too slow, or too busy just trying to pay bills. By the time they felt ready to buy, prices were already higher. The wealthy, on the other hand, were positioned to act instantly. Why is that? Because they play a different game. They have teams of analysts watching every move from the Federal Reserve. They get early signals from policymakers. They have access to cheap credit when everyone else is getting denied loans. And they buy assets when fear is at its peak. It might sound unfair, and in many ways it is. But it's also a reality you can't ignore. The wealthy play offense. They don't wait for the old rules of the game to return. They play the game as it is today, and here's what you can learn from that. You don't need billions to play the same game. You just need to shift your mindset. Stop thinking like a saver. Start thinking like an owner. When inflation rises, assets rise. When governments print money, assets inflate. That's where the real power is. So the question becomes clear. If the rich have turned crises into opportunities, how can you start building your own strategy to escape the paycheck-to-paycheck cycle? That's exactly what we'll cover next. We'll talk about how you can build your own passive path step by step so you can grow wealth even when the rules keep changing. You don't need to be a billionaire to win this game. You just need to change how you play it. And that starts with one shift. Stop trying to time the market. Start owning assets that grow over time. Waiting for the perfect crash is like waiting for the perfect day to start working out. It never comes. And if it does, you probably won't recognize it until it's gone. The wealthy don't rely on perfect timing. They rely on consistent action. One of the simplest strategies is dollar cost averaging. That means you invest the same amount of money every week or every month, no matter what the market is doing. Sometimes you buy high, sometimes you buy low, but over the long run you end up with an average cost that smooths out the ups and downs. Here's an example. Imagine you invest $200 every month in an S&P 500 index fund. Some months the price is high, and you buy fewer shares. Other months the price is low, and you buy more. After 10 years, you don't just own stocks. You own a piece of hundreds of companies across the American economy, and historically, that basket has grown even through recessions. Real estate is another path. Maybe you don't have millions for a downtown condo, but you can start small. House hacking is one option. Buy a duplex, live in one unit, rent out the other. Your tenant helps cover the mortgage. You build equity without depending on luck or timing the market. Then there are REITs, real estate investment trusts. These let you own a piece of commercial buildings, apartments, even warehouses without ever fixing a leaky pipe. They trade like stocks, but they pay out dividends. Don't forget side businesses. In North America, some of the most powerful wealth engines are small businesses. It could be an online shop, a digital course, or even a YouTube channel like The Passive Path. You create something once, and it keeps earning for you. That's true passive income. And here's the best part. You don't need to choose just one path. You can combine them. A little in index funds, a rental property, a small online side hustle. Together they build layers of income that protect you from the next storm. So stop asking, when is the next crash? The better question is, what assets am I building right now? Because here's the reality. Whether the market crashes or the government prints more money, assets will always hold value. Cash won't. The game has changed, but you can still win. In the next part, we'll talk about what to do when the next crash does happen. Because even in this new world, downturns haven't disappeared. They just look very different. Crashes haven't disappeared. They still happen, but they don't look like the old ones. In 2020, the stock market lost more than 30% of its value in just a few weeks. People thought it would take years to recover. Some even expected another Great Depression. But within months, the market hit new highs. Why? Because the government stepped in with massive money printing and stimulus. This is the new pattern. Crises are shorter. They're softer. They don't give you years to buy cheap assets. The window is tiny. And unless you already have cash ready, you miss it. Look at what happened in 2022 and 2023 with US banks. Several collapsed. It looked dangerous. The Federal Reserve raised interest rates to fight inflation. But behind the scenes, they quietly opened new emergency lending programs that kept the system from spiraling. The crash was managed. This isn't about luck anymore. It's about policy. When the government can print money at will, they don't let the system reset the way it used to. That means the middle class rarely gets a shot at bargain prices. Instead, the wealthy scoop up whatever falls because they have the resources and connections. So where does that leave you? It means you can't depend on waiting for the big collapse. You can't rely on the old strategy of jumping in after the dust settles. Because by the time you're ready, the rebound is already over. That doesn't mean you're powerless. It means you need a different plan. A plan that works no matter what the headlines say. That plan is resilience. Resilience means you keep investing even when the market looks scary. It means you have an emergency fund so you don't panic sell. It means you diversify so that one crisis doesn't wipe you out. It means you understand the system is built to favor those who own assets, not those who hold cash. The new rule is simple. Don't fear crashes. Don't chase them either. Build a strategy that works in both good times and bad. And that raises the bigger question. If governments can keep printing money, and if inflation is here to stay, what happens to the future of the dollar itself? That a euro fits what we a euro fits we'll talk about next. The future of money, the role of the US dollar, and what it means for your wealth. The United States has a secret weapon. It's not just the military, it's the dollar. Right now, the US owes more than $37 trillion in debt. That number is so big it's almost impossible to imagine, yet the country hasn't collapsed. Why? Because the world still trusts and uses the dollar. The dollar is the reserve currency of the world. That means oil is priced in dollars. International trade often happens in dollars. Banks around the globe hold dollars as their safety net, so when the US prints more money, other countries absorb some of the impact. But here's the danger. What happens if the world decides it doesn't want as many dollars? What if countries start trading in euros, UN, or even digital currencies? Then the US can't push inflation outward. Instead, all that printed money stays inside America, and that's when inflation could spiral at home. Look at other countries for examples. Argentina tried printing money to handle its problems. Inflation exploded. People abandoned their local currency and started using US dollars instead. A lifetime of savings was wiped out. Turkey faced something similar. They printed heavily. Their currency lost about 70% of its value in just 2 years. Prices soared. Everyday life became more expensive overnight. The US is different, but not invincible. The dollar's strength depends on global demand. If that demand weakens, the US will face the same risks other countries face. At the same time, new players are stepping in. China is pushing for the yuan to be used in international trade. Digital currencies are rising, with Bitcoin often described as digital gold. Even governments are exploring their own central bank digital currencies. This creates uncertainty. Will the dollar stay dominant? Will a new system replace it? Or will we move into a world where multiple currencies compete for power? For you, this is more than just global politics. It affects your savings, your investments, your future cost of living. If the dollar weakens, assets will rise in price, but everyday expenses will rise too. So the question becomes clear. If the future of money is uncertain, how do you protect yourself? How do you make sure your wealth survives no matter what happens to the dollar? That's exactly what we'll explore in the final part. We'll focus on practical steps you can take right now to prepare for whatever comes next. Do you like this personality? The rules of money have changed. Crashes don't reset the system like they used to. Governments now print money to keep things alive. That means inflation eats away at your savings, and the wealthy keep getting richer because they own assets. So what can you do? The first step is to stop relying on cash as your main safety net. Cash is important for emergencies. You need a cushion for unexpected bills or job loss. But beyond that, cash loses value over time. The second step is to own assets. Start small. If you can save $100 a month, put it into an index fund. That money will grow with the market over the years. You don't need to pick individual stocks. The S&P 500 has historically gone up over time. The third step is real estate. Even if you don't have the money for a house, there are options. Look into house hacking. Consider real estate investment trusts. Over time, property values rise with inflation. Rent checks become steady cash flow. The fourth step is building income streams. Don't rely on a single paycheck. Start a side hustle. Launch a small online business. It could be as simple as selling products on Etsy or creating a YouTube channel like The Passive Path. One stream of income protects you. Multiple streams give you freedom. The fifth step is education. Money has its own rules, and those rules change. If you don't learn them, you'll always be behind. Read books, follow financial news, keep watching content that breaks down complex ideas in simple terms. Knowledge is leverage. And finally, think long-term. The wealthy don't panic when prices fall, they see it as part of the journey. You can do the same. Set a plan, stay consistent, invest through ups and downs. Because here's the truth. You don't need to outsmart Wall Street. You don't need to predict the next crash. You just need to stop playing the old game. Start playing the new one. Build assets. Build income streams. Protect yourself from inflation. Focus on the long game. The system may not be fair, the rules may have changed, but you still have power. And the sooner you start, the better your future looks. If you found this valuable, hit like. Subscribe to The Passive Path for more videos on building wealth and financial freedom. And share your thoughts in the comments. What are you doing right now to protect your money? The game has changed. You can't wait for the old rules to come back. But if you learn how the system really works, you can turn it in your favor. That's the path to freedom. That's the passive path. I wish you clarity, courage, and success on your path to financial freedom. Keep learning, keep building, and I'll see you in the next video.